Hello students, welcome to the lecture on financial business decisions and leverages. And after this lecture, we will be able to learn the following objectives. Define the analyzing financial business decisions, explain the cost volume profit analysis, understand the break-even analysis, and explain the exploring the concept of leverage in finance. Analyzing financial business decisions. Let us start with how the finance department works. The finance department of a company generates a variety of financial information that is helpful in decision making, including profit and loss accounts, providing details of whether the business is making efficient use of financial resources. By providing a steady and up-to-date flow of information, a business is able to make appropriate decisions about how to reduce costs, how to increase sales, how to raise profitability, when to purchase new capital assets, the best sources of finance and duration, etc. Accounting is the business function of recording, reporting, and analyzing financial information. Several types of accounting tools are available for business owners to analyze and assess the strength of their company's operations. Financial statements. The most common accounting tool used for business decisions are financial statements. These statements usually include the income statement, balance sheet, and statement of cash flows. Financial ratios. Financial ratios are a more in-depth analysis of the company's financial statements. These ratios take specific pieces of information from the financial statements and use mathematical formulas to create numerical indicators. Forecasting. Forecasting is an internal or external analysis method used to determine the potential production output or sales of the company's products. Investment analysis. Investment analysis may include analyzing new business opportunities that will maximize the company's profitability, selecting equity securities to generate passive income streams, or securing debt financing for business funding. Management accounting. Management accounting is an internal business function used to allocate business costs to goods or services produced by a company. Cost volume profit analysis. Cost volume profit (CVP) analysis is a technique that examines changes in profits in response to changes in sales volumes, costs, and prices. Profit equation and contribution margin. CVP analysis begins with the basic profit equation. Profit is equal to total revenue is equal to total costs. Separating costs into variable and fixed categories, we express profit as profit is equal to total revenue minus total variable costs minus total fixed costs. The contribution margin is total revenue minus total variable costs. The contribution margin per unit is the selling price per unit minus the variable cost per unit. Advantages and disadvantages of cost volume profit analysis. Decision making. CVP analysis provides managers with the advantage of being able to answer specific pragmatic questions needed in business analysis. Detail. Another major benefit of CVP analysis is that it provides a detailed snapshot of company activity. Limitations. The CVP approach to analysis is beneficial, but it is limited in the amount of information it can provide in a multi-product operation. Approximations. Even though CVP analysis is based on specific data and requires tremendous attention to detail, the best that it can do is provide approximate answers to questions rather than ones that are exact. Break-even analysis. Break-even analysis is a technique widely used by production management and management accountants. It is based on categorizing production costs between those which are variable and those that are fixed. Break-even analysis is used to determine when business will be able to cover all its expenses and begin to make a profit. To determine break-even point, use the equation. Break-even point is equal to fixed costs, unit selling price minus variable costs. The break-even chart. In its simplest form, the break-even chart is a graphical representation of costs at various levels of activity shown on the same chart as the variation of income or sales revenue with the same variation in activity. The point at which neither profit nor loss is made is known as the break-even point. Fixed costs. Fixed costs are those business costs that are not directly related to the level of production or output. Examples of fixed costs are rent and rates, depreciation, research and development, marketing costs, non-revenue related, administration costs. Variable costs. Variable costs are those costs which vary directly with the level of output. Semi-variable costs. Whilst the distinction between fixed and variable costs is a convenient way of categorizing business costs, in reality, there are some costs which are fixed in nature but which increase when output reaches certain levels. Marginal costing. Marginal costing is a technique of ascertaining cost used in any method of costing. According to this technique, variable costs are charged to cost units and the fixed cost attributable to the relevant period is written off in full against the contribution for that period. Features of marginal costing. It is a method of recording costs and reporting profits. It involves ascertaining marginal costs, which is a difference of fixed cost and variable cost. The operating costs are differentiated into fixed costs and variable costs. Fixed costs are treated as period charge and are written off to the profit and loss account in the period incurred. Marginal contribution decides the profitability of the products. Margin of safety. In break-even analysis, margin of safety is the extent by which actual or projected sales exceed the break-even sales. It may be calculated simply as the difference between actual or projected sales and the break-even sales. Thus, MOS is equal to budgeted sales minus break-even sales, or budgeted sales minus break-even sales MOS budgeted sales. Exploring the concept of leverage in finance. Leverage is the process by which a business person, entrepreneur or investor is able to greatly increase the return on an investment through the use of borrowed money. Financial leverage. In the financial world, leverage is the amount of risk a person is willing to take. The greater the risk, the greater the potential payoff. Options. An option is the right to purchase a piece of property, stock, real estate, etc. at an agreed upon price during an agreed upon time frame. Options can be used to either speculate, in which the speculator expects the price to rise, or to hedge, insure against a rise in price. Selling stock short. A short sale involves a speculator contacting his broker and selling the stock owned by another investor. Financial leverage lights on an elusive concept. Financial leverage is at the heart of the current financial crisis, and now is as good a time as any to shed light on this elusive topic. Many people think it is effective to control risk by limiting leverage, but that is a trap to be avoided. We speak of leverage when an institution's financial assets are larger than its capital An institution is exposed to the change in value of a position more than the amount that it paid for the position, or an institution owns a position with embedded leverage. Leverage can have impact on two aspects of the investment position. Exposure. Due to the extra investment, extra exposure is created to a market, region, investment style or factor. Risk. As a result of the extra investment, returns and also risks, or better, volatility are magnified. L is equal to 1 plus A whole upon 1, where A is the ratio of money borrowed to the ratio of money owned. Replication is not constant for derivatives. Options can be replicated by buying or selling the underlined and holding a position in cash. This insight is in fact fundamental to the pricing of options. The ratio of underlying stock to hold can be calculated from the option pricing formula and is referred to as the delta of the option. Leverage and risk. Under some limiting condition, the relation between leverage and risk is simple. If we assume a portfolio is levered by borrowing a truly risk-free asset, then using leverage only magnifies and shifts the distribution of returns. The distribution of returns shifts to the right if the return on the portfolio is larger than the return of the risk-free asset. It shifts left otherwise. L is equal to Rp minus Rf whole upon Ra minus Rf, where Rp is the return on the portfolio, Rf the return on the risk-free asset, and Ra the return on the underlying asset. Leverage introduces new risks. The most important additional risk is that liquidity becomes much more of an issue. Leverage enhances funding liquidity and asset liquidity risk. Leverage on a portfolio is not constant through time. When the return on the risk-free asset becomes high in relation to that on the assets, but still less than that on the assets, leverage rises fast. Exploring operating leverage. Operating leverage measures a firm's fixed versus variable costs. The greater proportion of fixed costs, the greater the operating leverage. Like financial leverage, operating leverage magnifies results, making gains look better and losses look worse. Exploring combined leverage. Combined or total leverage is the total amount of risk facing a business firm. It is the total amount of leverage that we can use to magnify the returns from our business. Summary. Now in the end, let us summarize what we have learnt in this lecture. The finance department of a company generates a variety of financial information that is helpful in decision making. Financial statements usually include the income statement, balance sheet, and statement of cash flows. Cost volume profit (CVP) analysis is a technique that examines changes in profits in response to changes in sales volumes, costs, and prices. Break-even analysis is based on categorizing production costs between those which are variable and those that are fixed. In break-even analysis, margin of safety is the extent by which actual or projected sales exceed the break-even sales.